All right, folks, good morning, if you can call it that. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. What a trading day it is already turning out to be, the second day of the week. Today is Tuesday, the 13th of September. I'm your host here for the broadcast today, JD Durkin. This is true. Today is Positive Thinking Day, National Positive Thinking Day. And if there's one thing right now that investors across the major market indexes could certainly use, it is positive thinking. We did have the ringing of the opening bell a short time ago by Hall de Lumiere, a new digital art center, in celebration of its opening tomorrow. But you'd be forgiven if you said that whoever rang the opening bell or any of the other components of what make the market move is not the story of the day. You would be correct. We are going to take a closer look at what's on tap this morning. And of course, the story is the hot inflation data that came out at 8:30 a.m. Eastern Standard Time, and how markets are responding, plus the latest on Peloton. And in case you haven't yet had your coffee, don't worry. We do have a bit of news on Starbucks coming up. About an hour and a half ago or so, hour 15, we received key inflation data that investors were waiting for in the form of the August Consumer Price Index report, coming in quite a bit hotter than expected. And we are seeing the results at the moment. The Street expected an 8% increase year over year. The report showed 8.3. It is one of the last pieces of data the Fed will take into consideration next week in its September meeting. Markets have been enjoying a bit of a relief rally in recent sessions, at least 13 minutes into the trading day today. That is certainly not the case. If we turn our attention to the big board and see how investors are reacting, I should say, the Dow Jones currently down 1.7%, S&P 500 down 2.1% to start the day. The tech-heavy NASDAQ at the market site in Times Square down 2.9%. The inflation data, we'll break it down with Martin Baccardax here in just a moment, pointing to a more aggressive Fed. That is the situation that investors are dealing with here now, 14 minutes into the trading day. And let's dig right in. For more on what's moving the street this morning, we now turn to our senior editor, our markets correspondent, the only man I would want to talk to in a situation where there is red all over the big board in a morning like this, Martin Baccardax. Okay, Martin, so an indication from a few of the traders I spoke with, we've been having this conversation about, will it be 50 basis points, will it be 75? Traders I spoke with here on the floor say now, because of this data, there is about an 18% chance. Was this unthinkable that Fed Chair Jay Powell is going to go up a full percent? Take 75 basis points off the table. It's only 18%. It still seems like overwhelmingly we're looking at 75 basis points. But Martin, what do you make of the data we saw at 8:30 and the investor reaction here the first 15 minutes of the day?
Certainly seems like an overreaction, at least on first blush, JD, I'd have to say. I mean, I go back to sporting and Las Vegas and the way that bets are accumulated. Ultimately, the bookies don't really have any greater understanding of what's going to happen in the game than you or I, but they collate a whole bunch of wagers coming in. They set the line. They try to get it just right so where they can cut a profit. And then, of course, they almost always do, and then they move on to the next game. There isn't going to be a 100 basis point rate hike next week from the Fed. There was never going to be a 50 basis point rate hike from the Fed. There was always going to be a 75 basis point rate hike, and I really don't think that the inflation data today changes that in any significant way, because the Fed has been consistent for the past 2 or 3 months telling us that they aren't going to do anything different until they see compelling evidence that inflation is declining. They haven't talked about evidence that inflation is going to spike back up again, because arithmetically it is not, but they wanted to see inflation coming down before they deviated from their set path. And that path has been articulated to indicate a 75 basis point rate hike next week, and then similarly sized but probably smaller rate hikes between now and the end of the year. So, much like a bookie in Vegas, interest rate traders are accumulating all of the bets coming in on movements next week and beyond, and they're setting a price and they're taking bets on either side. That gives us that 18% probability for the 100 basis point rate increase. Stay with me if you're following all these numbers, but it probably doesn't change the game, even though people are going to be disappointed by the data we saw today.
Martin, one of the favorite metrics that you write about and when you file your stories very early every weekday morning for TheStreet.com is something that I've grown fond about discussing with you, that CME Group's Fed Watch. You had written, this is pre-market, of an 88% chance of 75 basis. Do you have access to that information so far this morning? And I'm curious if that has changed from CME Group at all, or is it largely in line with your previous response?
largely in line with what I was seeing, but nonetheless, I think it's important to keep looking at, because ultimately, again, it does sort of provide us an indication of how traders are betting going into it, but probably it's more indicative of what they anticipate will happen. There's always money to be made, some bets on either side, but the smart money is going to be on the reaction function of the Federal Reserve. And the Fed Watch tool is probably pointing us to somewhere between 80 and 90% probability of that 75. There's enough probability for the 100, again, to accumulate wages and maybe make a little bit of money along the side. But I don't think anything has particularly changed in a dramatic way, even though we are seeing those increases in the bigger bets. I think what will ultimately be in question is whether or not the terminal rate for the Fed funds rate, in other words, when the Fed will stop raising rates, is probably higher today than it was yesterday. Will it stay that high? It's probably at 4.1% or so right now. That's another question that will probably be answered by the numbers that we get for September inflation, October, and beyond. And arithmetically, that does seem to be a certainty for it to decline. But the surprise number in August has raised enough questions that people are willing to put bets out there in the marketplace on that higher terminal rate.
So that's interesting to me, Martin, because I think you've been very smart to point to the fact that you say whether it's 50 or it's 75 or whatever, what's more important is where this whole thing's going, right?
Yeah.
Don't look at the short term. We're playing the long game here, and it seems to me as if you're arguing that, and I think you've said before, I think you just said 4.1, that it's somewhere between 4 and 4.5 where Jay Powell ends up landing. Sounds like maybe there's more of a possibility for that number to even go up a bit higher. Is that correct?
Yes, I do.
I interpret that correctly? Yeah.
Yes, no, you absolutely interpret it correctly. I think it will go a little bit higher, but not significantly higher. Wow. So the two questions will be whether it stays at that elevated terminal rate, and if it does, what impact will that have on growth dynamics in the U.S. economy, which it's always worth remembering is the biggest in the world. Now, the reason I point to that is because what we are seeing in the bond market is something called an inverted yield curve. Now, that's a fancy way of saying that investors are, for the most part, worried about inflation in the short term and growth in the longer term than they normally would be. So therefore, they are positioning borrowing costs for the U.S. government at a much higher rate in a near term and a lower rate in the longer term. Now, when that inversion happens, it generally portends recession. It's not an infallible metric, but the study from the San Francisco Fed suggests it's probably the most reliable one that we have in terms of predicting inflation over the next 12 to 18 months. And we're starting to see more and more chatter about a 2023 recession. Shallow as it might be, it's still a contraction that will probably lead to job losses and other dislocations in financial markets as a result. And that, of course, puts in question the Fed's ability to engineer that soft landing that we've always talked about, which is where they raise rates in order to tame inflation, but not to a level that snuffs out growth. If the terminal rate is to rise much faster or much higher than 4.1%, we could be looking at choking off growth, and that could tip us into recession. And we are seeing bets as a result of that, and they're being played out in the bond market as we speak.
And not a direct comparison, but it's a good time perhaps for students of history or young investors to do a bit of dust up on the late 1970s, around 1981. You're going to hear the name Paul Volcker and the Volcker sticker shock, the Volcker shock on the markets, and many other key inflation points going back all those years ago. Not a direct comparison, of course. I think Jay Powell's playing with a different set of fundamentals than the nation faced back then. But there'll be more than a few comparisons. We have other stories to get to with regards to other companies. I just want to give you an opportunity, Martin. Is there anything else that we didn't hit on this conversation? Because I think especially in terms of traders that are looking at the markets today, this is obviously this is what they're dealing with front and center. So before we move on, I just wanted to keep it open and say anything else top of mind for you for context.
Well, I'm glad you asked that, JD. I really am, because one of the numbers that really leapt off the page for me in the August inflation report was the spike higher that we saw in food prices. And this is really serious. We are looking at the fastest increase in food prices since 1979. They rose a little bit more than 11% on the year, and that was at just under 11% on the year in the month of July as well. So the average bill that Americans are facing as they go to feed their families on a weekly basis is rising significantly. And wages are simply not rising as a result to make up for those increases. Wages are only rising at around 5 to 5.1%, and that's for hourly workers. For the most of us who are staying in our jobs, we're not seeing any pay increases at all. So our purchasing power is actually declining when these basic necessities, the price of these basic necessities, are rising as a result. So this, I think, is significantly important. It's important in terms of margins for companies that are reliant on food sales, and I'm talking about people like Walmart, Target, Kroger, and others. It's important with respect to discretionary spending in the sense that if people are having to pay more for food, they're going to buy less in terms of the things that they would actually enjoy as opposed to the things that they need, and that includes clothes, shoes, video games, and other things. So I do think that this is an important metric for us and one that has big implications for spending dynamics in a consumer-driven economy and ultimately a political implication as well. The last thing any government wants to do is go into a midterm election defending the biggest rise in food prices in 4 decades. That is just simply not something that's politically tenable.
For anyone that's watching the live stream, just give you an update here. We are 23 minutes into this trading session. The Dow down 1.7, S&P 2.1, NASDAQ down 2.8%. And I'm going to come back to a big board check from time to time here because things appear to be moving just that quickly. Martin, thank you for the context, the perspective. I think that's incredibly helpful for the retail investor and those playing the long game alike to get a sense on exactly what is happening today, especially after the relief rally that we've had. We had green on the board for the first time in a long time. People starting to take a sigh of relief. Not so much today. Okay,
not so much.
You want to talk P-Time? Let's talk a little. Yeah, you're not kidding, and we'll see what it looks like as the day goes along. Let's talk Peloton. Much like a Peloton bike itself, the company appears to be spinning its wheels and not really going very far. Shares are down. They were down in pre-market, and they continue to be down after it was announced the company's co-founders will leave. Shareholders continue to be disgruntled. That's not a new story, Martin, in and of itself. Peloton shareholders being disgruntled. What else did the company say in its announcement?
Well, really what they're saying as a result of these departures of the co-founders, one of them was the CEO just a few months ago, John Foley, is that the turnaround plans are continuing apace and they're effectively trying to mark an exodus of the old guard that had run this company prior to the pandemic. Now, in the pandemic, of course, we know that they saw a surge in sales as a result of people exercising at home and staying at home as a result of isolations and restrictions on travel all around the country. But they had great difficulty in meeting that demand because of the supply chain snarls and the difficulty in getting parts from different areas and manufacturers around the world. They're trying to address some of those. They are actually now outsourcing manufacturing to a company in Taiwan, and Peloton wants to focus on sort of the connected fitness aspect of their offerings. They feel that there's more margin and potential in the subscriber base, staying within the Peloton network, if you will, and buying more services, signing up for more classes, and ultimately generating more revenue that way. But that is a really risky prospect when, in fact, you were seeing increases in their tread and bike prices that are meant, of course, to blunt the inflation impact, but they're going to be harder and harder to pass on to customers who are seeing an already expensive piece of equipment rise even further when, as we've talked about, spending dynamics in things like food and energy and rent and airfares are also rising. So there's going to be a corresponding contraction in the things that people are willing to spend upon, and you would imagine that fitness equipment is going to be one of them. People are also going back to gyms as a result of the pandemic restrictions being lifted and people heading back into normal activity. So that's a headwind for Peloton as well. Furthermore, actually, JD, they have some concerns with respect to a fine to the Consumer Protection Agency as a result of allegations that they didn't follow safety advice in the construction of their treadmill. And that, of course, last year led to a recall of the Tread Plus, and that followed the tragic death of a young child who was entangled in a piece of equipment in their parents' home. So a sad story that's probably going to lead to a significant fine as far as the company is concerned, and that just adds to the headwinds that the stock is facing as a result of the broader economy and also as a result of the missteps that the company has had under the previous leadership team.
Of course, that was a terrible tragedy for that family and something that the company has, of course, had to respond to. And I appreciate that you bring that up because oftentimes, right, our job is to to look at the numbers, to look at the data, to look at the impact and the earnings. And oftentimes for any of these stories, there's a deeply human component.
Yes.
And so we talk about the finances for Peloton, but it's because of something that's so serious. And so I think I always appreciate that in our conversations, because we can't forget,
It's worth,
at the end of the day, that's what's most important.
No, it's true. And I really think it's important for me to say this as well, JD. Peloton did not shy away from their responsibility in this. They stood up and accepted responsibility. They were deeply apologetic to the family, and they were quick to react as well. So I think they understood the tragedy in the same way that we did. And I wouldn't want to insinuate that the company was trying to hide behind anything as a result of that. They were very responsible in their actions afterwards, and they're not trying to sort of sweep that under the carpet. And I do give them credit for the transparency in their reaction, but also in the fact that they are going to have to likely pay this fine to the Consumer Protection Agency as a result.
Shares of Peloton currently down 8.5%, though to be fair, on a day like today, it's tough to know if a lot of that pullback is because of the first story that we've been covering. If it's part of this, obviously we said that pre-market shares for Peloton were already not looking like it was going to be a positive day. So on a day like today, it could be a little bit of everything. I do want to talk about Starbucks. Investor Day presentation, shares were up fractionally in the pre-market. Also, I mean, this is just the case market-wide right now. It's down nearly 3%. So obviously it's a tail of the tape that's changed dramatically. What is some of the information we often see from Starbucks at Investor Day and presentations on a day like today?
The most important number that we're probably going to get from Starbucks is whether or not they want to maintain their longer-term earnings growth trajectory. They see it in the range of 10 to 12% a year, and that's an important number for investors. It's going to be predicated on growth in China for sure, and that, of course, is linked to that country's COVID-0 policies and whether or not stores in that country are going to remain open between now and the end of the year, and indeed beyond. So Starbucks hasn't given us detailed financial guidance as a result of those uncertainties, but the broader, longer-term objective is the one that we're likely to see from today's Investor Day, and it will be an update on the numbers that they gave us in December of last year. We also would like to find out a bit more about the strategy with respect to capital investment and the retooling of a lot of the cafes around the United States in particular. It's about 15,500 Starbucks locations around the country. They're going to get upgrades in terms of equipment and refurbishing and different things like that, because all of us are really changing the way that we consume. I don't necessarily want to describe Starbucks as fast food, but let's just say convenience food. We're spending less time in the dining rooms at places like Starbucks and McDonald's and Chipotle and others. We're using a lot of the drive-through. We're using a lot of the online ordering and things like that. And that's creating a different headache for these companies as they try to manage this changing demand structure. So there is going to be some upgrade as a result for Starbucks, and it's going to cost a significant amount of money. Input costs are also rising with respect to not only coffee, but food. As we've talked about earlier, food price inflation is not just a consumer issue, it's a business issue as well. So profit margins are going to narrow as a result of that increased spending and increased input costs. And investors are going to want to know exactly how much they're going to narrow going forward so they can understand the price earnings metrics of a company like Starbucks, which is also more important given the fact that Starbucks has suspended share buybacks because they want to invest more in their staff. They're going to raise wages. They're now at $17 an hour for virtually everyone across the board, and they're higher for non-union members than they are for union members, and that is another controversial point that will probably be addressed in the Investor Day today, because of course Starbucks is facing a relatively expanding union. They have membership now in 200 locations around the country. That's a small portion of the 15,500, but it is growing, and it is a component of the relationship that Starbucks has with its employees, and that's really important.
So, and I'm glad you went there, because that's where I wanted to take the conversation next.
Yeah.
It's what started in Buffalo has unsurprisingly grown. We had Workers United organize walkout of employees across store locations in Kansas City as well as Seattle recently. And I want to get your perspective on how much of a headwind unionization is for Starbucks, and to what degree might we hear more about that from the company today, or is that something that the company may be taken into consideration and say, yeah, maybe we don't talk about it too much?
Yeah, I think they will. Howard Schultz alluded to it. He's the interim CEO. He's going to be handing the reins to Laxman Nashariman in the next few months. He was the former CEO at Reckitt Benckiser, which is a big brand giant that's based in London. He'll take over in April of next year, but he's going to work with Schultz between now and then. But Schultz alluded to the union relationship earlier this year when he suspended the buybacks. And essentially, he said, listen, the cash that we're handing back to shareholders can be better used improving not only the customer experience, but the employee experience as well. And that was really a nod to the rise in that union development that you alluded to, which began in Buffalo. Again, it's small enough not to be an immediate concern, but it's significant enough to be a longer-term concern for Starbucks, because ultimately, as all of us know, the ability of the barista to deliver us our product in a timely fashion is critical to whether we shop there or not. And if you have a disgruntled employee who's not motivated to work at their maximum capacity, that is going to have a direct and immediate impact on revenues, and therefore, as a result, the share price, the earnings metrics, and everything else. So it's critically important for Starbucks in a way that it isn't for a lot of other companies, because these baristas work incredibly hard and, quite frankly, sometimes under very difficult conditions, where they are, liable to have their hands scalded by very hot steam and water and milk and other things like that. There's a demanding customer base. When they're working at peak times, it's a relentless pace of operation. So there's a lot of argument for unionization in some of these companies. And I think Starbucks has to make sure that that argument doesn't become so compelling that it's spread across a majority of its operations. It's still a small number now, but that doesn't mean it won't be a big number this time next year.
Absolutely. All right, let's move on here to our rapid fire section if we can with our remaining minutes here in the show this morning. Martin, first up, well, I feel like I know how you're going to answer this one. President Joe Biden taking an inflation victory lap. Is it time for this? Go ahead.
I don't think this was the victory lap he intended. I think all of the expectation was that we were going to see slowing inflation metrics in the month of August. He was going to have an event at the White House today that touted the signing of this Inflation Reduction Act bill, which is effectively a climate change bill, to be honest, with branding that is making it a little bit more politically palatable. But I think the hope was he was going to be able to triumph that. And it's no small beer. It's $430 billion, and it will have significant impact on climate and drug prices and other things. But I think he had hoped that he was going to be able to dovetail it with another slide in inflation figures, but he didn't get that today. So it's going to be slightly more awkward, I think, at the White House today than it would have ordinarily been on a day that was designed to triumph a significant bill that nonetheless isn't quite delivering what it promised.
Martin, I admit it was Monday Night Football, which means I was watching the Manning brothers on ESPN2. I did not watch the primetime Emmys, but the Emmys got 2 repeat winners last night. What are we looking at here? What's the story?
I mean, for me, this is a lot of fun. Obviously, Ted Lasso, the Apple TV series, has been an enormous success. So it's won Best Comedy for a second year in a row. Succession is also a repeat winner for Best Drama. Of course, the story of a family that's, some say very closely related to the Murdoch empire, although I see a lot of nods to a man that many of you might not recognize, but those in Britain would, is a man named Robert Maxwell, who used to run the Mirror Group about 20 or 30 years ago. Relentlessly entertaining series with some incredible performances. But ultimately, apart from the talent that we're seeing in both projects and their incredible popularity, the fact that the Emmys probably deliver us titles that are more familiar to us than the Oscars does suggest that television and streaming are here as a force in global entertainment in a way that movies just don't seem to be able to recapture. And that, of course, has incredible probability and projection for streaming companies, for online media companies, and things like that compared to the movie studios. And it just does remind us that we're in a changing game in terms of entertainment, and streaming is where it's at. And the Oscars, I mean, quite frankly, they just feel a little bit old.
Absolutely. I know that is a take that many people agree with. Okay, finally here, let's move on. Okay, the Twitter whistleblower testifying to the Senate. Democrats want to hear from Republicans, want to hear from. What should we expect from this hearing?
This is a fun one. The former Twitter head of security also goes by a nickname in the hacking community known as Mudge. So this is a man who is definitely very much intricately involved in the understanding of security at big tech companies, not only at Twitter, but other parts of the economy as well. He's going to be testifying to Senate lawmakers about some of the allegations that he made last month with respect to Twitter maybe being more focused on profits and growth than internal security and the protection of user data. Now, of course, we know that politicians are incredibly sensitive to this discussion because Twitter has become an enormously important component of their communication strategy. And there have been allegations from both the left and the right that voices are being snuffed out as a result of Twitter's algorithm in order to meet a particular political consensus. So I wouldn't imagine the lawmakers are going to pull any punches with the questioning to the whistleblower today. What will be interesting to me is whether or not these have any impact on the judge's decision in October with respect to Elon Musk's disputed $44 billion takeover of Twitter, which the company is also going to vote on today.
Yes, the Court of Chancery news cycle next month is going to be a wild one. The great Martin Baccardax taking the time for us here at this trading day, and we'll follow along and see what investors have in store as the Dow now is down 2.1% on this Tuesday. Martin, thank you so much. That's going to do it here for Opening Bell here from the floor of the NYSE. Stick with TheStreet.com for more on these and every other major market story that matter to you. We'll see you later.